Most business owners, they look at their P&L and they feel relieved. And yes, the revenue looks good, the net profit looks fine, and they feel like a sense of relief of what exactly gets them in trouble. But in my experience, when a business fails, it almost never starts in the P&L. It starts quietly, invisibly on the balance sheet. So today, I want to talk about why your balance sheet has been warning you for a long time and why most business owners don't know how to listen. Because this is not an accounting lesson, because as a business owner, that's the least important thing that you need to know. But this is a decision lesson. So welcome to today's episode. So why this matters? I work with business owners every day and they tell me the same thing. Oh, on paper we're doing well, but something feels off. And guess what? Most of them are not wrong, because the problem is that most people were taught to look at the financials emotionally. Oh, the revenue feels amazing, it's success, and the profit is like validation, like, oh my god, I'm making enough money to live off well, and I'm being successful. But most businesses break because of exposure and not because of emotions, and that exposure lives in your balance sheet. So if you don't understand your balance sheet, you don't know actually how strong your business is or where you stand. So what is the common mistake I see? Most business owners, they treat the balance sheet like the compliance document. Okay, oh, that is something that my accountant needs for tax preparation, or oh, I only see my balance sheet once a year. Well, it looks fine because no one explained it to you. But most owners think if my P&L looks good, then the balance sheet must be fine too. That assumption just right there is very dangerous, because the balance sheet tells you what your business is built on. It tells you the real story of your business. And some businesses are built on fragile foundations, so the balance sheet doesn't tell you how you perform. That's your P&L. But if you want to know exactly what position is your company right now and what position is your company right now, then pay full attention to your balance sheet. So if you're seeing the balance sheet as just the accounting reports, then that's your mistake, okay? Because in my experience, I don't see the balance sheet as accounting reports. The balance sheet, they're actually like maps. They give you all the roads that are coming from the past that will give you a hint for the future. They are also your decision mirrors. Everything that is happening in the balance sheet is the mirror of the business. And also it stress tests your business. So when I open a balance sheet, the first thing I ask to myself is it everything reconciled? Because if it is not, then I'm not having the real picture of the business. I'm thinking about in an accounting point of view. What if there are loans that are sitting on the balance sheet? Are they reconciled? Are they true loans? Is that a real debt? Okay? Because if it is not, then it's gonna be impacting everything else. But not only those accounting questions I ask myself when I see a balance sheet. Another question that I think it's one of the most important ones, and mostly because of COVID, is how dependent is this company on debt? That's my main thing. Like, if this company is relying on debt 100%, oh my God, there are a huge red flag here. So what happens if cash flows down? Cash flow slows, okay? That's something that happened in the pandemic. That's something that happened in COVID. Nobody had enough cushion funds for them to be able to run their businesses. So that follows my next question. Where is this business vulnerable? Those are the things that the balance sheet tells you. It's not about the position of the company. It's not about the performance of the company. It's about the position of the company. So if all the loans are paid and they're still showing as reminders in your balance sheet, or if any of your balance sheet accounts on the asset side are not reconciled, so you know what? We're looking at noise. That's not a balance sheet. And what noise brings is chaos. So let me simplify you this. The balance sheet answers 3 critical questions. How liquid you are, because can you survive short-term pressure? How leveraged you are. How much of your business is funded by debt or obligations? And the last one, but not least important, is how resilient are you? Because is your business able to absorb bad decisions? And that's your capital. That's your money. I've seen a lot of profitable businesses collapse because they couldn't answer these questions. They didn't understand the structure and they were making money. So as an accountant, I'm going to share with you the patterns that I see constantly. So the first one, profitable companies with no cash. We call them profit rich, cash poor. Huge red flag. Owners reinvesting all their money aggressively without understanding the leverage. It's really important that you have that considered when you are making investment decisions. Business growing revenue, but they're also growing liabilities. How leveraged is your business? If you're growing the revenue, but you're also growing liabilities, then there's something you need to check. And the numbers are rising and they look good, but do they? The balance sheet always shows the risks first. Always. It's not the profit and loss. So here is why the balance sheet always shows risk first. The balance sheet doesn't show your performance. That's the P&L job. The balance sheet shows you position. The P&L tells you what happened over time, but the balance sheet tells you where your business is standing right now. And every risk in your business stands in the position, meaning it stands in your balance sheet, not in your performance. So when a business takes on debt, delays payments, builds receivables, don't have any cash or enough cash, relies on short-term liabilities, like, oh, I opened this hole, I covered it with this one. That risk is there. It already exists. So the revenue can still look good for your business, and the profits can still be positive, but the balance sheet records the exposure immediately. And that's why it speaks first than your P&L. So the balance sheet tells you basically what do you have, what do you owe, and what's left if things slow down. So that's the reason why every major decision for your business hits the balance sheet first. Hiring, borrowing, spending, reinvesting. And they all create assets or liabilities immediately, long before they impact your profit and loss. So that's where we see problems. We as accountants see problems all the time, because if your loans were already paid but they are sitting on your balance sheet and your accounts haven't been reconciled, meaning bank accounts, and your numbers, you say they look fine, but they don't reflect the reality of your business. Because with the reconciliation is the process where we cross match that everything that happened externally, like in your bank accounts, in your credit cards, they are actually being reflected in your financial statements. So every time that we as accountants accept a new client, the first thing we do is we review the balance sheet, because that's where the noise is, and the noise is always dangerous. So if the balance sheet isn't clean, reconciled, current, then you don't have any clarity in your business. It's basically distortion of your business. And the balance sheet always shows distortion before any consequences arrive. Here is a question that I usually ask every client. What happens if revenue stops tomorrow? How long would your business survive? And they basically get, like frozen, because they don't know the answer. They think about profit. They think about the P&L, the profit and loss, but the profit and loss goes from January to December. So guess what? The answer is on your balance sheet. And a healthy P&L can hide any fragility in your business. And that fragility shows up until you have to make a decision. You make it with those assumptions, and then that decision fires back. It goes wrong. So consider the P&L as an informative financial statement for your performance, but not to make any major decision in your business. So remember, the decisions that will impact your financial statements, your balance sheet, and your profit and loss are basically composed into 5 groups: hiring, expansion, debt, distribution to shareholders or to owners, and acquisitions. So if you make the decision, as I said before, just based on your P&L and the big ones, for example, expansion, investment, real growth, if you make them with your P&L, you're basically like crossing your fingers that everything will be all right, because you don't have the right information to make those big decisions. And that shouldn't be your strategy for making decisions. You need to understand how your balance sheet impacts your decision making, and that should be your strategy as a business owner. So your accountant's job is to prepare the reports, but your job is, as an owner, is to understand what those reports are telling you. Don't look at the balance sheet as a boring report, because that's sometimes what my customers think, like, oh, that's a boring report, that's an accountant report. This might be, I'm talking about the balance sheet. The balance sheet might be the most honest report you will receive from your business, because it tells you where you're strong, where you're exposed, and what decisions you can survive. So are you really ready to listen to your balance sheet? Because your balance sheet is talking. So be ready to listen. Subscribe if you want more clarity and not noise, because this channel is about making better decisions and not more information. See you soon.